And welcome to the November Buy-to-Let Mortgage Market Update. My name is Richard Purnell and I'm from The Mortgage Home, and we are your buy-to-let mortgage experts. Okay, now I will go through the agenda we've got for November. We've got 4 topics as usual. The staple that's always there is my take on interest rates, Bank of England, what I think the projections are likely to be and impact on mortgages. Secondly, I'm going to talk about your credit score. It's something that clearly will impact every single person watching this video. So what can we do to improve our credit score? I'm going to give you some hacks and tips to do exactly that. We've had the King's speech this week. Oh, and by the way, I'm recording this on the 9th of November. It was the 6th of November, I believe, that King Charles trotted down to the House of Lords and went through the various bills that the government are likely to put through Parliament. And because there were several elements related to landlords, that I wanted to give my take. Not a political speech from me, not even from a landlord's perspective, but what might the implication be should these bills come to fruition for landlords wanting to get mortgages. So I've got a little piece on there that I think some of you will find interesting. And finally, and as always, I'm always looking for opportunities for you guys to save money. There's never a bad time to do that. And so here on life insurance premiums, here's the 2 things I want to mention that could really be of interest to you. If you, 1, have a life insurance policy, and 2, are either currently a smoker or recently given up smoking, you must, if you're only going to listen to one segment of this update, then fast forward to this one, because I'll show you how hopefully we can save you a significant chunk of change on your life insurance premiums. And look, if you've got 10, 20, 30 years still to pay on those, that's a hell of a saving. So stay tuned for that one. In this piece, I want to talk about interest rates. So what's going on in November? Now, the Bank of England have actually maintained interest rates for a second month. Oh my word, we're in uncharted territory here. Now we're sitting at 5.25% for the second month. So I feel we've now really entered a new chapter. We've finished with that phase of increasing rates to put a stop on spending and to get inflation going in the right direction. The Bank of England clearly feel that's really starting to hurt the consumers and certainly do its job, which is why 2/3 of the Monetary Policy Committee this month voted to keep rates the same. Last month it was really on a knife edge, 5 versus 4 to keep rates the same. This month 6-3. So the consensus is clearly to keep rates at that same pace. So I mentioned the word stability, which is what lenders want to hear, what the financial markets want to hear, because it gives them confidence. It gives them certainty, if we're in a period of stability, to price their mortgages looking forward. Now, what does stability mean in my terms? Well, does it mean that rates will not move? No, I would not be surprised if the Bank of England still have to tinker and tweak the Bank of England rate. So if in the next 3 months we see the 5.25 going to 5.5, don't be shocked at that. But does it mean we're starting a new phase of increases? Highly unlikely. Excuse me. Notwithstanding, of course, Middle Eastern wars and things getting out of hand. And of course, we've still got the Russia-Ukraine thing in the background. So there's those things can always come out of left field to mess things up. But putting that to one side, then the Bank of England do feel now these things are now being managed, certainly in the UK economy, a lot better. And therefore, we're in this stability period. But there may well be some sort of tweaking. Over the next 18 months, I would expect the Bank of England rate to pretty much be around this market, notwithstanding maybe a 0.25% adjustment up or down, just to get things right. Probably more up than down, because if inflation does stall a little bit, because it's at 6.7% now, it's still got quite a way to go to get down to the target of 2%. And therefore, if anything, we might see a slight tweak upwards if there's going to be an adjustment right now. I can't see inflation falling quicker than anticipated. So if anything, I can see a slight increase. And for the next 18 months, however, I see rates pretty much staying in the ballpark we're at right now. However, in 18 months' time, which is when the Bank of England expect inflation to be hurtling towards that 2% target, I can see them taking their foot off the gas. And that's where we'll start to see rates dropping. Now, will they go back to ones and twos? I've said before, those days are gone. Get rid of that notion in your head. However, dropping rates down to by 0.5 to 0.75% and maybe stabilising under 4.5 to 5% wouldn't surprise me, but we're not going to see that for a year and a half. Let's just look at this point at a chart that also highlights some of what I'm saying. Now, if you're watching on a laptop, you'll see this graph really clearly. If you're watching it on your phone, then maybe you're squinting at this point. So I'll do my best to describe what this chart is trying to tell us. And I just want to tease out a couple of points. But first of all, a bit of context. So this chart is set over a timeline of 2 years. September 21 on the left, across to November 23 on the right. And then on the vertical axis, we've got the actual interest rate from 0% up to 6%. And we've got 3 lines on it. The blue line is the Bank of England rate, and obviously it's gone from pretty much 0 on the left, looking like a mountainside, hitting that 5.25, and then it flatlines for those last 2 months on the right hand side of that chart. So we know that. The 2 other lines represent the average fixed rates over the last 2 years, and the red line is the average 2-year fixed rate, and the green line is the average 5-year fixed rate. And what I want to tease out, this is the thing. On the left-hand side, you'll see that the red line is below the green line, meaning the interest rate on average back in September, or certainly that last quarter of 2021, the 2-year fixed rate was lower, priced lower than a 5-year fixed rate. And that is normal. In my 25 years as a broker, that is what you would normally expect to see, because it's easier for banks, lenders, economists, the markets to predict what's going to happen in the next 2 years compared to 5 years. I mean, you'd say that about life. And it's no different in financial markets. Therefore, if they know what's going to happen in the next 2 years, they can price more keenly the products. Whereas once you're trying to price a 5-year deal, more uncertainty creeps in, more things can go wrong, and therefore they hedge their bets and inflate the rate to cover that potential risk accordingly. And that's normal. But follow that green and red line. You see where it crosses over. I swear, if I have to say this name one more time, I'm going to go mad here. It's like an unwanted relative turning up at Christmas. Here she is again. Liz Truss. This is going to be the last time. September, October 2022. You see that big peak there in the middle of the graph. That's where we went to hell in a handcart. That's where turmoil ensued. And that's also where the pricing turned on its head. And as you can see from that point onwards, the short-term deals were priced more expensive than the long-term. The red line is now above the green line. And if we follow that line right up to November 23, this chart is still telling us that on average, the short-term 2-year deals are still priced more expensively than the 5. Now, one thing I want to add to this as the broker who's at the sharp end of this is that I'm actually seeing more and more lenders almost on a daily, weekly basis starting to price their 2-year deals a bit cheaper. So I'm expecting this green and red line to narrow and narrow, and that red line, if I could show you this graph in 3 months' time, I would expect the red line to pretty much be crossing the green. Because, as I said earlier, we're in this period of stability, and that means that normal service should be resuming and the 2-year deal's getting cheaper. So right now, as landlords, you might feel that you're almost being forced to take a 5-year deal because they're 1/3, 0.5% cheaper than a 2-year fixed, even though you might prefer normally to take a 2-year deal. Well, expect that normality to return certainly by the start of the new year is my prediction. The last point I want to make on interest rates, and it backs up what I keep saying about stability, because the great news for us as brokers and, of course, landlords is that stability, what that means in real terms is that lenders are now reopening for business. They're chasing your business, which is why mortgage rates have actually been dropping, because they've got appetite to lend to you now. They feel confident that we've turned the corner, that we've gone from the previous phase of containing the problem to this stability phase. So I'm seeing now more innovative products coming out. And I also mentioned in last month's update that we will start to see relaxation of policy. And I want to give you one example today. TMW, the Mortgage Works. I believe they're the largest buy-to-let lender in the UK. Therefore, if they change something, if they relax policy, it's going to have a ripple effect across the majority of landlords. Now, TMW have had a rule in place for a number of years, specifically for those landlords with 10 properties or more. So when you want to submit an application to TMW, whether it be refinance or a purchase, they look at your background portfolio. And one of the things they look at is what the aggregate LTV of that background portfolio is. And they've always been really prudent of TMW and had a limit of 65%, that if your background portfolio went over 65%, they would decline your case, irrespective of how good a quality you are, etc., instant decline. And that bucked the trend because their competitors have pretty much always had a 75% LTV aggregate limit in the background. So great news that TMW have finally joined the party, lifted that restriction and pushed that 65% to 75%, which means as a broker, we can now look to TMW as well as the rest of the market for you larger landlords. And hopefully we can get, because normally TMW offers some pretty good, highly competitive products. So hopefully that's some really good news. And I'd be love to share more of that good news in following months with other lenders following suit. And finally, if you want to talk to the team about anything I've mentioned today, how does that impact you and your portfolio, or what you're looking to do in terms of making decisions for mortgages, book some time on with the team. There's no obligation. Book half an hour, have a good chat, and we'll give you some personalised feedback and advice as to what the best direction is. In this piece, I want to talk about your credit score and your credit history. I'm always asked, weekly, asked about how can I improve my credit score? So there's a number of ways that I want to share with you today. So please get your pen and papers out, make some notes on this section, and there'll be some takeaway tips I'm sure that you'll be able to put into place that will have an impact of improving your credit score. Listen, everybody has a credit score, and lenders are always making decisions on your credit score. So if there's anything you can do to push that scoring upwards, then that means you're more likely to get accepted and get those better rates. So let's get into this. Credit card usage. Now, there's an urban myth that says, oh, you've got to have a credit card to have a good credit score. And I sort of get where that comes from, but we've got to dive into the detail here to understand a little bit more about credit cards or anything with a credit limit. That could even be store cards, maybe even overdrafts to a point, but anything with some sort of credit limit. So the thing you've really got to keep a note on is how much you're spending as a percentage of your limit. Now, if you pay your bill off every month, happy days. I'm not asking you to change your behavior. That will work well. Paying your bill off every month will have a positive impact and will improve your score. So that's fine. But what about you guys that don't pay your bill off in full every month. You're paying a contribution or indeed the minimum amount. What's the implications there? Again, no issue so long as your debt is under a certain percentage of your limit. So it's a bit like loan to value here. So where's the sweet spot? I would say around 65, 70% is a healthy limit to how much you should be spending relative to your actual credit card limit. Once you're getting above 80%, then instead of it having a positive effect on your credit score, it's actually taking away from your credit score. And if you're up at 90, 95%, you'll see your credit score dropping. So look, if you've got a few thousand quid in savings and you're almost up to your limit on your credit card, then consider moving some of that money from your savings and just paying some of that credit card balance down so you're within that sweet spot I've talked about. That'll be a good use of your money, particularly if you are looking to get a mortgage in the near future. Now, here's one other thing. If you're thinking, well, why I haven't got a credit card, and this urban myth about, oh, I should get a credit card because it'll improve my score, you've got to be really careful, because at the point you take out a credit card, that provider and indeed a potential lender has no idea whether you're going to manage that credit limit responsibly or not. Therefore, in the first 3 to 6 months, when you've been approved for a credit card or indeed any other sort of financial credit, your score will drop. So do your best not to take out any new credit in the months leading up to you applying for a new mortgage, if you can help it, because it will take away from your score for a few months, and it's like going backwards to go forwards, that analogy. Once you've then got a little bit of history under your belt, around 6 months, you'll find your credit score has bounced back up and will start to improve on where it was 6 months ago before you took that card out. Right. Notice of corrections. If you've had some arrears or a default has appeared, and you're speaking to your provider, and maybe you're arguing the point that it's not your fault or there's extenuating circumstances, or maybe where does the fault lie? We're not quite sure. Is it you or is it the provider in that scenario? And you're speaking to the customer services team, and they try to suggest that if you contact your credit reference agency and put your extenuating circumstances on the report, that means that you've been able to explain why there's been arrears, why there's been late payments, and providers in the future may look at that and take that into account. I want to dispel that myth completely. Lenders will never look at anything that you write on a notice of correction. For me, it's a way that the customer services team are getting you off the phone so they can go on to the next customer. Because it makes you feel good if you're actually telling the world or the credit reference agency why you got into arrears. And there's always a sub story. There's always a reason why. And I hear these tales all the time about some really bad luck, some real, terrible scenario that's unfolded out of your control. And it just meant you were a bit late making a payment, or, it turned into some arrears for a time, but you got back on track. And if only you could explain why that is, then surely the lenders will have a heart. They do not have a heart. So the quicker we learn that, the better. So let's go back to the point of you're having that conversation with the customer service team. If you believe that provider may have been to blame, or indeed you are sure that they were to blame, do not be fobbed off with, "I'll put a notice of correction on." You turn that into a complaint. You use the word complaint, because that turns it from an informal conversation with customer services into a formal response that provider now has to do. They've got a regulatory requirement and policy that says we have to deal with this in a formal, timely manner. Whereas until it's deemed to be a complaint, now you shouldn't have to use the word complaint. However, let's not get into semantics. You should absolutely shout the word. All the calls are recorded. So as soon as a customer service person, they're trained to look out for that word, and they know that triggers them to deal with it formally. I'm not saying you're going to get the right outcome. What it means is that you're not going to get fobbed off anymore. Someone has to look at a different team, and perhaps you might get it overturned. CCJs. Now, here's the thing about CCJs. I learned years ago, and very, very few people know about this tip. If you are unlucky enough to get a county court judgment, whether you pay it off or not is going to stay on your file for 6 whole years and will have a detrimental effect pretty much for whole of that time. But there's an exception. If within the first 28 days of getting that CCJ, you pay it off, you satisfy that county court judgment, you can have it cleared off your credit report in full, like it's never happened. Your Tipex is out, it's disappeared. If you pay it off in day 29, yes, you can have your reports updated to say your CCJ has been cleared, but it still sits there. And frankly, most lenders, whether it's paid off or not paid off, will penalise you exactly the same. Certainly in the first 2 years. Beyond that, then it might have a positive impact if it has actually been paid off. So if that happens to you and you feel that, you know, you've gone to court to argue your point and you've lost on the day, do not let your pride get in the way of paying that debt. You now pay it off in full because it's in your interest. It will clear it off if you can do it within 28 days. So there's just a little tip. Now, I want to move on to financial associations. What does that mean? If you and I had a joint bank account or a joint mortgage or a joint form of credit, then financially we have an association. Now, what happens when we separate? What happens when we get divorced? What happens when that business relationship ends and you go your own ways? And maybe, I'm going to talk in simple terms, you've had a joint current account. And that current account has gone down to zero. There's no money in it, but it's still open. If it's still dormant, not being closed down, then that's a bridge, a financial link between you and that other person. And if that other person ends up with default CCJs, bankruptcy, repossessions, that ripple effect from them can come across the bridge and be associated with you. So what do you do about it? You get a copy of a credit report. I've said on this next bullet point, Check My File is one company that does a 30-day free trial. It covers the 2 main agencies, Experian and Equifax. It covers some others, but those are the 2 main agencies that lenders tend to use. And have a look through it. If you've not done it before, it's a really revealing, eye-opening exercise to see what sort of information lenders can see and are making decisions. Is it accurate? Is it up to date? Look at the financial association section, and if there's anyone on there that you're now no longer working with, that suggests there's products still open, find those products, get them closed down, they'll get removed, and get the financial association removed as well. The final point I want to make on this is that when people have got poor credit scores, I've been talking a little bit about prevention, but there's also people who have really struggled financially, struggled cash flow, struggled managing the finances. Maybe it's not their skill set to deal with numbers and deal with money, and have got themselves into problems and difficulties. I'm talking not just as a landlord, but as an individual, as a human being. You know, there are people that put their head in the sand a little bit when it comes to money and money management. And so over the years, I've produced it's actually a fancy spreadsheet that I call a budget monitor. And I've given it to, well, thousands of clients over the years. No charge. And it's just an extra tool for those individuals to set themselves a bit of a budget for the next year. It gives them a bit of structure so they can see where they're going, and they can record their actual spending so they can compare actuals to what they thought they were going to be spending. And then it generates a conversation just amongst yourselves as to whether you're on track or a little bit behind. So I've found, and my clients have found with the feedback I've got over the years, it's a really useful, practical tool. It's a lot simpler than an accounting package that you pay for. Once it's set up, it takes clients probably half an hour a month to complete it with actual transactions. And then, as I say, you can look to manage your finances. If you think, wow, that might be really useful, I'm more than happy to share it with anyone that's watching today. So my email address will be appearing around now. Chuck me an email saying, Richard, just send me a copy of the spreadsheet, and I'll be more than happy to share that with you. However, if you want to talk to the team about your credit report, as a company, as a broker, we're more than used to reviewing your credit reports and giving you some feedback on whether you can improve it. And that's done as part of a wider mortgage review. Then book some time in. There'll be a link at the end of this piece. Speak to the team, talk to them about your history, be really honest, be very transparent, no point hiding, keeping those skeletons in the cupboard. Talk to us about what's going on, and we'll give you what your options are going forward. So hope that's been of use to you. And yeah, follow that link through now if that's of use to you going forward. In this piece, I want to talk about the King's Speech, not the film, but King Charles, of course, visited the House of Lords on the 6th of November. And it really caught my eye because there's several bills that he mentioned in there that are going to have impacts for landlords. Now, this isn't going to be a political commentary from me, nor even what's the impact on landlords, but let's put it in context of if those landlords wanting mortgages, should these reform bills come to fruition? That's what I want to focus on. So let's get on with it. Now, there's two reform bills that King Charles mentioned. One was renters and the other was leasehold. So renters reform bill. We know that Section 21 is likely to be removed. We thought it was actually going to go through now, but it's been delayed. So it will come in my opinion. It's only a matter of time before no-fault evictions do get removed. However, what I was thinking is, well, what's the implications right now for landlords that are using Section 21 to remove a tenant? Because although there's a number of reasons why you want to get your tenant out of your property, overwhelmingly, the main reason is that they're not paying the rent. Now, what if at the point you've served notice, or you're about to serve notice, but essentially your tenant isn't paying up the rent, you want to refinance that property? You might think, and probably rightly so, that'd be a real struggle for a bank or a lender to approve that application. And you'd be right. Lenders will be looking at your bank statements and they'll want to see proof that the rent's coming in, because it's the rent that's going to service the mortgage. And therefore, if the rent stops, then you can understand underwriters getting a little nervous. But there may well be some exceptions here. I can't overpromise things. So if you're listening to this right now and you're thinking, wow, that's me, I would love to refinance the property. Maybe you're on standard variable rate and you're desperate just to reduce that interest rate. Maybe you want to release some equity and you're thinking, well, surely I can't do that until I've had my tenant removed, which, as we all know, takes months, and indeed then got a new tenant in. There might be some exceptions to the rule where we can speak to lenders who don't ask for confirmation of rent coming in, and therefore we might be able to get an application approved. So don't be too disarmed. So if at the end of this piece you want to talk to us in more detail about your case, then follow the link through, cut and paste it, and speak to the team, and let's see if we can give you some good advice on that one. The second bill is the leasehold reform bill, and there's a couple of elements to this that might have implications for getting mortgages. The first one is the lease. Now, they're talking in this bill about when you extend your lease, it gets extended not by 90 years, but by 990 years. And I think that's great news. Clearly, it gives stability for generations and generations to come. However, that has also been delayed. That's gone back out to consultation again. So who knows what the end result will be. So right now, if you've got a leasehold property, or you're thinking of buying a leasehold property, they want to be looking at, well, what's the lease term right now? And if that's dropped below, I'm going to say between 70 and 80 years, that's the zone where there's going to be an issue. That's where lenders are starting to quibble and take a view on whether they want to accept an application for a leasehold property when the lease term has dropped into that sort of level. Anything below 70 years, really, the first thing you've got to do is get that lease extended before you can refinance or purchase a property. In addition to that, there's a focus on ground rent. And I find this really fascinating in that this year, this has really raised its head. I've had several examples in the last few months where a lender has declined a case for a leasehold refinance because they checked the details of the lease in respect of ground rent that either allows the freeholder to increase the ground rent by a certain margin, a margin that a lender finds unacceptable, or the freeholder has already put the ground rent up to what a lender perceives as unacceptable. Now, what's unacceptable? Well, in examples that we had, we're talking about really modest figures. The figure had gone from £250 a year to £500 a year ground rent. Now, you might not even blink at that. Okay, it's an extra 250 quid. But in the big scheme of things, you think, okay, well, that's still, acceptable. Well, we're finding lenders who are saying otherwise and actually declining the case. So if you're thinking of buying, check the details of the lease, in particular when it comes to ground rent and what the freeholder is allowed to do. Because clearly it's a national issue if it's now being brought into the bill. Again, it's been discussed. So we're not sure whether it's going to go into statute or not, but the fact that it's even been put onto the bill in the first place tells me that it's a growing bigger issue on a national scale. So really be mindful of that. The last thing is about the ability to buy the freehold. And it's never been an issue from a lender perspective, but the point I want to raise is that if you are already the leaseholder and you think that you want to buy the freehold out, that from a legal point of view, you need to be buying the freehold in a different name. So let's say you own the flat in your sole name, you can buy the freehold in a joint name or a limited company name, and lenders will find that acceptable. What you can't do is have the freehold in the same name as the leasehold. So just a tip there, if that's something you're considering at buying the freehold, it's something you'll need to think about. And again, if you want to speak to the broker team about anything I've covered on this segment, there'll be a link at the end of this piece. Speak to the team about it, get the detail, get some clarity, get the specific advice so you can make the right decisions for you guys going forward. In this piece, I want to be talking about how you can save more money. I'm always looking for opportunities to share with you guys how you might be able to cut your spending. And here's another hack. So here's the point I want to make. Life insurance. Back in the 1970s, the number of smokers in the UK in men was 50% and women was 41%. It clearly dominated the UK. We were a nation of smokers. Fast forward to today, and we're down to about 6 million smokers. So over that time period, we've had more than 14 million people that have given up smoking. And that led me thinking about life insurance, because I know that if you apply for life insurance and tick the box to say, I am a smoker, your premiums will increase by, on average, 50%. And if you take that 50% increase, you might say, oh, well, it's £20 a month to £30 a month. But that extra tenner a month is £120 a year, is £1,200 over 10 years, and those thousands increase over the lifetime of the policy. So you are talking thousands of pounds that you could be paying extra because you were classed, and rightly, we all know about smoking and all the dangers, and therefore we understand why insurers increase the premiums. But that's the reality, that if you're classed as a smoker, that your premiums will increase significantly. But here's the thing. What people don't know is that if you've stopped smoking, as it says on this top bullet point, for 1 year, then what you can do is speak to us as advisors and we can get you reassessed as a non-smoker. The fact that you might have smoked for 20 years earlier will not have an issue so long as that's not already contributed to a medical condition. If the fact you've smoked has meant that now you have a certain disease or a certain condition, well, that's a different matter. But if you're still fit and healthy and you've now stopped smoking, you're not on patches, then we can get you reassessed and stop those high premiums, hopefully get them reassessed to something significantly lower, and let's get a chunk of change back in your pocket. So, look, this is a short and sharp piece today on saving money. But look, if you're thinking of stopping smoking, this might just be the catalyst, might just be the motivation you need to push you over the line to say, yeah, look, if I can save money, I've got life insurance policies. If I can save some extra money, not only the cost of not paying for cigarettes, but there's an extra saving on top, I'm really going to now roll my sleeves up. Then bear us in mind and we'll get you reassessed and hopefully we can start saving you some money. How do the insurers know that you've stopped smoking? Would be a really good question. At best, they're not even going to ask. If you tick the box on the form that you are currently a non-smoker, then that's it, game over. And you might think, wow, that is really trusting. But please bear in mind, at the point of claim, if you have a claim down the line, and for example, your GP records have you down as a smoker, because the reality is you never really stopped. You started, you were on patches, vapes, you're back to smoking, and that's reflected on your GP notes, then you could end up having a claim decline. So listen, although it's very trusting at the point of application, don't misunderstand me. You've got to do the right thing. At worst, on an application, what you'll find is that the insurer might ask for a blood test to be done to see if there's any nicotine in the blood as an assessment. But it's one of those two things that usually happen. But again, we can advise on that if you want to come and get some very personalised advice. So again, at the end of this piece here, there's a link to our online diary. There's an option for mortgage appointment or insurance appointment. Obviously, click on the insurance, speak to Victoria, who's our insurance advisor, and she will be delighted to help, point you in the right direction. There's no charge from us for advice in this arena. So take advantage of it, have a chat and get some personalised advice on what's the right way forward for you. And just to finish, here is that link for our online diary. Here's all the ways of getting in touch. And finally, just a list of the services that we offer. If you're not familiar with us, then as well as all the usual mortgages, as I've said a little earlier, we talk about life insurance, critical illness policy, income protection, short-term as well as long-term finances. Anything that's secured on bricks and mortar, we'd be delighted to help. Thank you so much for watching and listening to this month's update. Have a fantastic month, and we'll see you on the next update.